let's just dive right into this explainer by completely shattering a massive myth right out of the gate. We've all been sold this idea that if you just hustle, work hard, and achieve flawless operational excellence, well, your business is guaranteed to survive. You know the drill. Build a great product, hire a fantastic team, and you'll win. But honestly, the reality of business is way more brutal than that. Just ask titans like Netflix's Reed Hastings or Spotify's Daniel Ek. They know firsthand that without a deep, fundamental understanding of strategy, even the most incredibly well-run companies will eventually just get steamrolled. Hastings actually has this famous warning: everyone is trying to eat your lunch. And he's absolutely right. You can do literally everything perfectly on a day-to-day operational level, but without a structural advantage, your margins, they're going to get eaten alive.
So here's our roadmap for today's explainer. We're looking at the illusion of execution, defining true strategic power, the 7 strategic powers themselves, the timing or power progression, and finally, how to actually implement your strategy.
All right, let's start with part 1, the illusion of execution and this dangerous concept of competitive arbitrage.
We have to face a really harsh economic reality here. It's called competitive arbitrage. That's when your hard-earned innovations are just relentlessly copied until your profit margins completely vanish. Poof, gone. To stop that, you absolutely have to adopt Hamilton Helmer's ultimate mantra for strategy. He tells us that strategy isn't some fluffy vision statement on a whiteboard. It is, and you should really commit this to memory, a route to continuing power in significant markets. You aren't just trying to run the treadmill of operating better, you are literally trying to build an unassailable fortress.
Which brings us to part 2, defining true strategic power and what we call the Moat Equation.
Now, what's really fascinating here is how Helmer breaks down the exact anatomy of true strategic power into 2 non-negotiable halves. You absolutely have to have both. First, there's the benefit. Think of this as the treasure. It materially improves your cash flow, either by drastically lowering your costs or letting you charge higher prices. But then you need the barrier. That's the deep moat that stops competitors from just swimming over and stealing your treasure. It's a structural obstacle that makes copying you economically ruinous. Because look, without that barrier, any benefit you have is completely temporary.
Moving right along to part 3, the 7 strategic powers. This is essentially your ultimate defense playbook.
The absolute bottom line here is this. If your business lacks at least one of these 7 specific powers, I hate to say it, but you lack a viable, enduring strategy. It's that simple. We're going to walk through each of these 7 meticulously so you can see exactly how they shield a company from those ruthless forces of arbitrage.
First up is scale economies, and Netflix is literally the perfect example of this. As their massive subscriber volume grows, their per-user cost for making those billion-dollar original shows just plummets. I mean, think about it. They spread the fixed cost of a massive hit like Stranger Things across hundreds of millions of subscribers. So their cost per user is just a tiny fraction of what some smaller streaming rival would have to pay. It creates an absolutely impossible price disadvantage for anyone trying to compete.
Power number 2 is network economies. This is where a service actually gets more value as more people join it. Remember that startup Branch Out? They tried to take on LinkedIn. But because LinkedIn already had tens of millions of professionals on it, their platform was just infinitely more valuable to recruiters. It became financially unthinkable for a smaller challenger like Branch Out to ever catch up. Honestly, they would have practically had to pay users to switch over.
Third is counterpositioning. Now this one is super fascinating. This happens when a newcomer adopts a completely unorthodox, totally different business model that the industry giants completely refuse to copy. Why? Because doing so would totally cannibalize their own highly profitable legacy business. When Vanguard launched their low-cost index funds, traditional giants like Fidelity couldn't just mimic them without completely destroying the massive profits they were already making from high-fee active management. They were basically paralyzed by the threat of their own collateral damage.
Fourth is switching costs. And wow, this story brilliantly illustrates just how massive a barrier this can be. Listen to this. Hewlett-Packard lost a staggering $160 million just trying to migrate their enterprise software over to SAP. $160 million. It failed spectacularly and caused these massive server backlogs. But it proves a huge point. The financial, procedural, and downright relational pain of leaving an ecosystem can be paralyzing. When the headache of switching to a competitor is that massive, you're going to stay put, even if you absolutely hate the software.
Fifth on our list is branding. And to be clear, we are not just talking about a catchy logo or a clever ad campaign. This is about decades of accumulated trust that lets a company charge a massive premium for an objectively identical offering purely because of an emotional connection. Think about that iconic Tiffany's blue box. That specific color carries what Helmer calls effective valence, which, okay, is just a super academic way of saying it has a deep emotional connection built over a very long time that competitors simply cannot replicate overnight, no matter how many millions they dump into marketing.
Power number 6 is cornered resource. This basically means having preferential access to an incredibly coveted asset, like Pixar's legendary brain trust of creators. But here's the catch. It's not just about having a smart team. To actually be a cornered resource, it has to pass 5 really rigorous tests. It has to be idiosyncratic to your firm, non-arbitraged, meaning their high salaries don't just eat up all the profits, transferable, ongoing, and sufficient enough to drive massive returns entirely on its own.
7th, and the final power on our list, is process power. The gold standard for this is the legendary Toyota production system. We're talking about routines and activity sets that are so deeply embedded and highly complex that rivals literally couldn't replicate them even if they had the exact blueprint of the factory floor. Competitors used to actually tour Toyota's factories, walk right through them, and they still couldn't copy what they were doing, because the real power relies on this intricate web of embedded knowledge that takes a massive, extended commitment of time to build.
All right, let's jump to part 4, the power progression. Because in strategy, timing really is everything.
Now that we know what the 7 powers actually are, we need to understand exactly when you can build them, because these windows of opportunity open and close really fast. Helmer actually maps this out chronologically. He shows that specific powers are strictly tied to 3 distinct lifecycle stages of your business's growth: the pre-growth origination phase, the rapid scaling takeoff phase, and finally the decades-long stability phase. Let's break down which powers belong where.
Starting with the origination stage. This is way before explosive sales even begin. During this phase, you have to act incredibly decisively to secure those coveted assets for a cornered resource or totally invent a heterodox business model for counter-positioning. Your route to power has to be locked in extremely early here, often way before your competitors even realize what you're doing.
But when you hit the takeoff phase, the rules of the game change entirely. It turns into an absolute sprint against competitors to gain relative market share, lock in those users, and hit critical tipping points before the window totally shuts. So if you're trying to build scale economies, network economies, or switching costs, you have to scale faster than anybody else. If a rival beats you to that tipping point right here, the game is virtually over.
And then finally, we reach the stability phase. Here, you're relying on powers driven by hysteresis. Don't let the fancy word intimidate you. It literally just means these powers require decades of mature time accumulation to actually build. You simply cannot rush branding or process power. They require a long, extended, proven history of delivering value to build that deep trust and those wildly complex, inimitable routines.
Okay, let's bring this all together with part 5, implementing your strategy and actually building that moat.
This is where we see how this brilliant framework translates into an actionable instruction manual for your own venture. The absolute foundation of implementation is this simple phrase, "Me too won't do." You just cannot copy your way to strategic power. You have to start with genuine invention to create real value, a new product, a totally new model, a new brand. But you have to remain urgently vigilant so you can immediately wrap one of those 7 powers around that invention before competitors arrive. The invention creates the spark, sure, but it's the power that builds the fortress around it.
This framework is just a massive game changer because it cuts right through the endless noise of vague business theory. It replaces all that fluff with a focused, concrete menu of 7 proven paths to lasting dominance. As Helmer says, without this framework, strategy feels like an essay question. But with the 7 powers, it literally becomes a multiple-choice question. When you're sitting in that boardroom, you aren't staring at a terrifyingly blank piece of paper anymore. You are looking at 7 specific options to secure your future.
So, taking a really hard look at your own company's current stage of growth, I want to leave you with this crucial, provocative question to think about. Are you just running on the treadmill of operational excellence, just hoping that working harder will save you? Or are you actually building a true structural moat? Remember, true strategy is a route to continuing power in significant markets. So, what is yours?